In 2024, thousands of YouTube videos told you the same thing. Form an LLC, file your paperwork with the government, or face criminal charges. 2 years in prison, $10,000 in fines. That law is basically dead right now for most LLCs in America. And almost none of those videos have been updated. If you searched, "Should I start an LLC this week?" you probably got advice that's already wrong. Here's why this matters right now. The rules around LLCs changed hard in the last 2 years. Some of it got easier, some of it got more confusing. And some of the facts everyone repeats were never fully true to begin with. Quick disclaimer before we go further. I'm not a lawyer, I'm not an accountant. This is research and analysis, not advice for your specific situation. Always check with a professional before you file anything. By the end of this video, you'll know 3 things. 1. What actually happened to that scary reporting law and why most of the internet hasn't caught up. 2. Whether an LLC actually saves you money on taxes. Spoiler, probably not by itself. 3. Whether an LLC actually protects your personal assets. That one might surprise you. Let's get into it. In 2024, a new rule called the Corporate Transparency Act kicked in. It said most LLCs had to report their owners to a federal agency called FinCEN. Miss the deadline, and you could face real penalties. Creators went wild with this. File now or go to prison became a whole genre of video. Then in March 2025, everything flipped. The Treasury Department reversed course. If your LLC was formed in the United States, that federal reporting requirement got removed. Not delayed. Removed. As of right now, most domestic LLCs don't have to file that report at all. But here's the part nobody's saying loud enough. This is a policy pause, not a repeal. The underlying law is still on the books. Courts have upheld that it's constitutional. A final rule is still coming sometime this year. And states are stepping in on their own. New York now has its own version of this law, active as of January 2026. Other states are watching closely, so the old fear-based advice is outdated. But ignore this forever is also bad advice. This is something to check again before you file, not something to forget about. That's the federal paperwork side. Now let's talk about the reason most people actually want an LLC in the first place. Taxes. Here's a sentence you've probably heard. Start an LLC and save money on taxes. By itself, that's misleading. An LLC on its own doesn't change how you're taxed. If you're a single owner, the IRS treats your LLC exactly like a sole proprietorship. Same tax forms, same self-employment tax. Nothing saves you a dollar just by filing the paperwork. The actual tax savings people are talking about come from something else. It's called an S-Corp election. That's a separate choice you make with the IRS on top of your LLC. An S-Corp election can lower your self-employment tax, but it adds real costs. Payroll processing, more complex bookkeeping, often a separate tax return. For most side hustles and small freelance income, those extra costs eat the savings completely. The math usually only works once your business profit crosses a meaningful threshold, often somewhere around $40,000 to $60,000 a year, depending on your situation. Below that line, you may be paying for complexity that gives you nothing back. Here's a rough example. Say your side business profits $20,000 a year. An S-Corp election might save you a few $100s in self-employment tax, but payroll and extra accounting can easily cost more than that. You'd be paying to lose money. So if a video's entire pitch is LLCs save you on taxes, it's skipping the most important part of the story. Taxes are one myth. Now let's talk about the other big reason people form an LLC: protection. This is the big one. An LLC protects your personal assets. It's true, but it's true with conditions most videos leave out. An LLC creates a legal wall between your business and your personal life. In theory, if your business gets sued, your house and your personal savings stay safe. In practice, that wall only holds up if you treat it like a real wall. Mix your business money with your personal checking account, and a court can decide the wall never really existed. That's called piercing the corporate veil. It happens more often to single-owner LLCs than people expect, because there's no second owner keeping things separate. There's also a bigger issue. For a lot of solo creators and freelancers, the actual liability risk is small to begin with. If you're not manufacturing products, hiring employees, or signing big contracts, your real-world risk of getting sued may already be low. Think about a freelance graphic designer working from a laptop. No inventory, no employees, no storefront. Their realistic liability risk is a client dispute, not a factory accident. A good contract and a cheap insurance policy might cover that risk better than an LLC ever could. In those cases, a solid insurance policy sometimes protects you better and costs less than the LLC does. An LLC isn't fake protection, but it's not automatic protection either. It only works if you run it properly, and it's not always the most efficient tool for the risk you actually have. So, reporting law, mostly resolved, still worth watching. Taxes, no automatic savings. Protection, real but conditional. Here's the honest verdict. An LLC still makes sense if you have real liability exposure. Physical products, employees, client contracts, anything that could realistically get you sued. It still makes sense if you're bringing on a business partner and need clear legal separation between owners. It still makes sense once your income is high enough that the S-Corp election actually pays for itself. It makes less sense if you're doing this purely out of fear from an outdated video, or purely chasing tax savings that don't exist yet at your income level. The paperwork changed, the tax rules didn't move much, and the protection was always more conditional than the thumbnails made it sound. Here's what to do next. First, check the current rules for your state. What I've covered is the federal picture as of early 2026. Your state might have its own LLC requirements, its own reporting laws, its own filing fees. Don't assume New York's rules apply to you, and don't assume they don't. Look it up for your specific state. Second, talk to an accountant before you assume anything about taxes. The S-Corp math is different for every income level, every state, every business structure. A 1-hour consultation now is cheaper than fixing a tax mistake 2 years from now. That's the actual 2026 answer. Not fear, not hype, just what the rules actually say right now. And that's the whole reason this channel exists. Financial advice ages fast, and most of the internet never updates it. This channel does. So if you want a second opinion, the next time a piece of popular money advice quietly stops being true, hit subscribe. I'll make sure you hear about it first.